Can you see the presentation? Food that I'm having for dinner, Alex, mate, you love food. Alright, so basically today is just going to be like an overview of the Forex strategy that I use to trade. It's called Price Track, and as a clue by the name, we're aiming to track price in between support and resistance. And then we'll be looking for the price to break out and retest. And then when this happens, we look to enter our trade on the retest part of the movement. So if price breaks up above our resistance, and then it comes back as a support, then we'll be looking in this area for certain confirmations to happen, and then we'll be getting in for a buy. And then the same as if price broke down below the floor, below the support, and then comes back up to use the same or previous support as a resistance. And then at that moment in time, we'll be looking for certain confirmations to then be able to execute a sell trade. So that is what we are looking for with this strategy. Now, how we mark up our support and resistance is that we generally look for the high and the low of the move, and then this gives us our support and resistance zones. So to draw this, what I do is I normally draw one horizontal line to the wick. So where the wick is on the candlestick, I would draw a horizontal line there, and then I would draw another horizontal line on the body of the candle. So one on the top of the wick and one on the top of the body, and then I'd draw make that into a zone where the two lines are. So that's how I draw my support and resistance zones. And then also, once you've found your support and resistance zones, it's always good to look in the past for confirmations of the zone. So basically what that's referring to is, if you look back at the past price action, you want to see the zone that you just drew being touched as many times as possible in the past. So it confirms that that is a zone of interest in the market, and that you want to be paying attention when price comes to them zones. Now, the technical indicators. So make sure you take, I'll just build that up for 2 seconds in case someone wants to take a photo, or if you're writing notes or anything. Right, and then we move on to technical indicators. So the technical indicators that you'll be using in this strategy are the EMA. So the EMA line, we call it an EMA 50, but it's just because in the setting we put it to a 50 bent. So yeah, the EMA 50, and then done chain channels again at a 50 length. And then in a bit, when I show you trading view, I'll explain them done chain channels in more detail, because they're a really good technical indicator to help you see support and resistance in the market, and it can also be another confirmation that your support or resistance zones are in the right place. The third technical indicator that we use in this strategy is called the TDIGM, and then settings that you want for that is 21, 34, 72. And the TDIGM is also referred to as shark money. And again, I'll show you that on TradingView in a second. And then the fourth technical, well, it's not really a technical indicator, but it's a technical tool, and that's the fib retracement tool. And the settings that I have for my fib retracement tool are 0, 0.38, 0.5, 0.62, and 1. And the reason for that is because I think a lot of people get confused about using the fib retracement tool. I get asked a lot, like, do I draw it from the top to the bottom, or do I draw it from the bottom to the top? Do I draw it from wicks or the body of the candle, or zones to zones and supports and resistance and all this? But people, they just overcomplicate it. So the reason I have these settings is because if you used to draw it from top to bottom and then draw it from bottom to top, then zones 0.38, 0.5, and 0.62, they're the same. So no matter what way you draw it around, you always get the same result. So that's why I use them settings, because obviously when sometimes the market can move quite fast when it's breaking out and retesting. So sometimes you haven't got long to make, obviously get all your confirmations together, draw your fib tool and enter a trade. And that's enough to do without worrying, which way should I draw this and everything else. So just by having them settings, it means that whatever way you draw the fib tool around on your chart, it gives you the same entry point. Now, there are certain rules for this strategy, and the first price track rule is to check the harmonic scanner for setups. Now, the harmonic scanner actually is one of IM's, I think it's IM's maybe their first product, and I know that it's free with the package as well, Forex package. And a lot of people don't use it because I guess it's free and they think it's not really that great, but it's amazing. It really is. It basically shows you the most high probable setups in the market. So that's why that's the first rule, because you've got into the harmonic scanner, it will show you the most probable setups, and then you can mark them setups on your trading view, and then obviously it gives you the most probability that that setup is going to come to pass. The second rule is to draw your support and resistance, or make your price traps on the 1 hour time frame. And that's a pretty solid rule. So you can't really mark up your price traps on like a 15-minute or a 30-minute. Always make sure it's on the 1 hour, because later on, one of the confirmations is that you get a 1 hour candle close above or below your zone. So yeah, always do your price traps on the 1 hour time frame. The third rule is obviously to find your highs and lows in the market structure. So knowing where price is and where you think it's going to go. So, is it making lower lows and lower highs, meaning a downtrend, or the opposite for an uptrend? And then obviously once you find them highs and lows, you can draw your price trap zones. And then obviously once them zones break and retest, that's when you enter the trade. Obviously the fourth rule, as I mentioned a bit earlier, was to look in the past for confirmations of the zone. So you can do this by, if you go over to the 4 hour time frame, then you can go back in time on the chart. And obviously what you want to be seeing is price to be touching them zones that you draw, and using them zones in the past as support and resistance, and that will confirm to you that the zones that you drew are in the right place on the chart. And obviously there are times where, like, you look at a chart and there'll be like loads of really long wicks on the candles, and the candles are not really moving in a good price structure way. So for me, I just leave the pair. So if you're ever looking at a chart and you think, I don't really know where the support and the resistance is, then just leave the pair and go to a different pair, because the way this strategy works, alongside the harmonic scanner as well, is that there are so many opportunities for you to get into the market and the trade. So don't just be jumping in on ifs and whats. If you're not sure where the support zone, resistance zones are, and you're still not sure once you've looked at a higher time frame, and just leave the pair, because there are loads of other pairs you can look at to get into the market. And then obviously, yeah, the fifth rule is to wait for the 1 hour candle close before you talk about a breakout. So what I mean by that is that if you are one of these people that constantly watch the charts, so like every 10 minutes you're pulling up the chart looking, and you see that the candlestick has, say, broke your either support or resistance zone, and you think, oh my God, it's broke. When it comes back, I'm going to get in for a retest. And then in the same candle, it pulls back into the zone, and then they're jumping in on the trade. And then when that candle actually closes, it might close in the opposite direction. So what it leaves you with is just a little wick outside of your zone. And obviously that's not valid enough as a breakout. So you really want to be waiting for the 1 hour candle close before you even talk about a breakout. And then rule number 6 is no retest, no trade. So I think that pretty much explains itself, really. So if there's no retest, at least back to the zone, then there's no reason for you to be getting into the trade. There's no reason for people to be going, oh my God, I was following the confirmations and I jumped in the trade and then price reverse and I lost. Well, if you would have waited for like a proper retest and confirmations, you would have seen that you probably shouldn't have got in when you did. So it's really important to make sure you're following all the rules before you get into a trade. Now, risk management. So what I do when I trade is I twin trade, but this does not mean that we're doubling our lot size or our risk. What it means is that we're dividing it. So, for example, if you're looking to place a trade at, say, 0.10, and that's equal to your 1% risk, and you want to risk 1% on the trade, what you would do is you would do 2 trades of 0.05, and then them 2 trades equals your 1%. So you can see that we've divided it, we're not doubling it. Now for stop loss, people always ask where you put your stop loss, and for me, it will either be above an engulfing candle, a morning or evening star, or the previous high or low, plus the spread. So obviously the candlestick patterns that we are looking for a confirmation when price comes back to retest are generally an engulfing, a morning star or an evening star. So you can generally just put your stop loss maybe a couple pips above them, or obviously above your last high or low point. I mean, the reason why I say plus spread, and obviously plus a couple pips above your confirmation candle, is obviously for spread. So you just want a little bit of space there to allow the market to move, and obviously that will incorporate the spread, because obviously like for me, when I first started, I never used to incorporate a little bit of space for price to move because of spread, and I'd always get like wicked out. My stop loss would get wicked out, and then price would like absolutely take off. And I think, oh my God, if that didn't wick me out, I'd have been in business. Like, I'd have had loads of profits. But you know, it's a lesson. The market was teaching me a lesson. I finally see it. So now, obviously, I allow for that spread as well when I'm setting stop loss. And now for obviously your take profit, which is obviously a take profit. Sorry, so a stop loss. Going back to that, stop loss is a point in the market, basically where you say if price comes back up to this point, what's going to happen is it's going to close out that trade for you, obviously, and you're going to lose your 1% that you've risked. But obviously, always have a stop loss. But don't ever think, oh, I'm not going to put stop loss because then I won't lose, because you just lose a lot. So obviously, always make sure you are putting stop loss. And then a take profit is a certain point in the market where if price reaches it, it will close out your trade for you with whatever profits or whatever pips you put in, or obviously your risk to reward ratio as well. So if my stop loss is 10 pips or higher, then I will put my take profit as 30 pips. The reason for this is because I've done a lot of back testing. And it seems to be that the market generally always would hit 30 pips before it retraced. And obviously, I learned this strategy from a really good IM educator called Anthony Paris, AP. So if you ever hear someone mentioning AP in the group chat, that's what it is. It's Anthony Paris, and he teaches this strategy. And obviously, that's one of his risk management rules as well. And obviously, he's been doing this a lot longer than what I have. So he's obviously back tested this a lot longer. And obviously, his advice is that the market will generally, I believe he says 80 to 85% of the time will hit 30 pips before or if the market decides to return and retrace. Now, if the stop loss is 10 pips or less, then we're doing a 1 to 3 risk reward ratio. So what that basically means is, so if say your stop loss is 10 pips, then your take profit will be 30 pips. Say your stop loss was 8 pips, then your take profit would be 24 pips. If say your stop loss was 7 pips, then a 1 to 3 is 21 pips. So that's generally how it goes. And obviously we're twin trading, so that would be our first trade. So if you're risking 1%, that trade you would be risking 0.5%. And if that clears, obviously that's a 1 to 3 risk reward ratio, or a minimum of 30 pips. And then take profit 2, we use shark money, or the TDI-GM technical indicator, which when used right shows us when market is going to turn around and reverse. So it gives you the best opportunity to take the most profits out of the market in that trade before the price reverses back towards obviously where you entered into the trade. And then also after 20 pips in profit, so if you're 20 pips or more in profit on your trade, what you want to do is you want to move your stop loss to break even. So what this does is it takes all the risk out of the trade. So even if price was to reverse and come back, and it was to hit your stop loss / break even, then you're not risking anything. You've shut the risk down from your trade, so you'll break even. So the good thing is you won't lose any money. And a good example of this actually was it was yesterday for me. I was in a trade, and my take profit 1 got hit. So I think it was I think I had a 7 pip stop loss. So it's a 21 pip take profit, and then so my take profit 1 got hit. My second trade was still running with the TDI-GM, but unfortunately the price reversed and come back up, and I'd already moved my stop loss to break even, so I didn't lose anything on that trade. I still managed to secure a 1 to 3 risk reward. So it's really important to always remember to move your stop loss up to break even, so that you obviously take that risk out of the trade for yourself. And then I've just put here 1% a trade, 2 orders of 0.5% risk, because that's genuinely what I use when I trade. I sort of risk 1% a trade. I obviously twin trade 2 orders at 0.5%. But obviously, it's when it comes to working out your 1%, depends how much you've got in your trading account. And obviously, some people might risk 1.5%, or they might risk 0.5%. So when you start to trade in the market and get a feel for it, obviously you'll be able to know exactly what percent you want to risk on a trade. And I generally say that 2 to 4% a day growth, and when you lose 2%, stop trading and reflect on what went wrong, which obviously is very important to do, as we all know with HFX as well. It's always to reflect to see what went wrong. Because I've done it many times where I've sort of got into a trade too early, and obviously prices come back up and took me out, and then it took off. So there's always little things you can go back and look on to see what happened. So obviously you're learning, not making the same mistakes over and over again. So that is pretty much it for risk management. What is the confirmation checklist? The confirmation checklist, these are the 5 things. 5 things that have to happen in order for you to get in a trade. So if you're in a trade and these 5 things haven't happened, then sorry, but I don't know why you're in a trade. But people are like that. They're like, oh yeah, there was a 1 hour candle close, and there was like candlestick patterns, all the time frames. I ended on the fib, but they've missed. It didn't come all the way back to the zone, so you can never skip a step. These are here for a reason. So obviously, always make sure you follow them. So the first one is obviously that 1 hour candle close, either above or below the zone. The second one is the retest, at least back to the zone. The third confirmation is a clear candlestick pattern, closely above or below the EMA 50. The fourth confirmation is all time frame candles match with the trending bias. So if you was to flip from the 1 hour down to the 30-minute, down to the 15 minutes, they should all be matching the trending bias. So if you was looking for, say, a sell, and it was on the 1 hour time frame, and it had, say, a blue candle, so it was going up, and then the 30 minutes was going up, but the 15 minutes had like a red engulfing candle. People are like jumping in trades. Oh yeah, there's the candlestick pattern, but obviously they're not taking into consideration the rule of the 1 hour, the 30-minute, and the 15-minute time frame have to all be in a trending bias. So again, make sure obviously you're following all of the rules. And then number 5 is to enter on the closest fib level. And obviously a good thing to do, like what I have personally, like in front of my desk here, like behind my laptop, I have printed out my HFX confirmations, my Forex confirmation checklist. So literally when I'm looking at a trade, I just look up and go, right, boom, 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 yeah, all 5. So, I'd say if anything, print out your confirmations, have them with you, so that every time you're looking at a trade, you can go through your confirmations. Like, I know the confirmations like off by heart, but I still like to have them in front of me, physically go, yes, 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 yes. So that might be a little bit of a nugget for you, if you would like to do that. Candlestick patterns and fib entry. So the candlestick patterns that we are looking for in particular are the engulfing candlesticks and the morning or evening star candlestick patterns. Make sure to read. Oh, yeah. So obviously, I hope everyone here has actually got a copy of. Can you just put in the chat if you have a copy of the Candlestick Bible at home? Yeah, and yes, Lydia, yes. Lauren, no. Nicole, no. Okay, so Right, let me just write that down. Well, I'm gonna send into the I'm gonna get, because I've got it saved, so I've got an electronic copy. So I'm just making a note. Send candlestick Bible into the group chat. And then yeah, it is quite long. But you know, don't just keep at it, because for me, my trading, it really changed when I read the Candlestick Bible. And you learn so much about price action and the different candlestick patterns and everything. And then, because it's like, so say for example, you was to talk to an English person, right? You're going to understand what they're saying because you speak the language. If you spoke to, say, a French person, you don't speak French, and they're speaking French to you, you ain't going to understand his language. You ain't going to be able to know what's happening, what's happened in the past, or you don't know what he's going on about, what's going to happen in the future. And it's the same for trading, for the markets. The candlesticks are the language of the markets. Each candlestick is telling you something. It's telling you whether price is going to go up, whether price is going to go down, whether price is in indecision. You don't know what it wants to do. The candlesticks are the language of the market. So if you can really understand what the candlestick patterns and price action movements mean by reading the Candlestick Bible, you'll literally be able to look at the charts and think, I understand exactly what this chart is telling me, because now you speak the language of the market. So just really, really read that and make sure that you do, because as I said, when I read that, it really did change the way that I see everything happening in the market. So make sure that you definitely give that a read. I've just drawn up the 4 basic ones that we look for in this strategy here on the presentation. So this one to the far left with the little blue candle up and then the big black candle, that's obviously what we call a bearish engulfing candle. So if we was looking for a sell and we see this candlestick pattern happen, say in our zone, when it's come back for the retest, and that would be a good candlestick pattern, and that would be telling us that price is now most probably looking to push down or move into the downward direction. And then the same for the one next to it is obviously the bullish engulfing candle. So you have a large blue engulfing candle over the black candle, which is telling us the price had come down to a certain point, and then the buyers have really took control of the market, pushed it right up. So that's the bullish and bearish engulfing candlestick patterns. And then to the right-hand side, you see the evening star. And the reason why this one's called the evening star is because you can see that price was coming up. So you had this blue candle, and then you can see you had a small candlestick. Doesn't matter whether that candlestick's blue or black. So it doesn't matter if it's a candlestick that ends moving up or ends moving down. And it's generally quite a small candlestick. It can also be like a doji, so not much of a body. It could literally just be like the width with like a little line as the horizontal. Again, obviously, make sure you read the Candlestick Bible, because all these different candlesticks that are being mentioned, obviously, are all in there. And then obviously the reason this is called an evening star is because obviously this little candle that's in between, it's at the top. So it's generally looked as like, you know, like sun is like, that's called a star. But if you look at it as like the sun is up in the sky, and now price is moving down, so that's coming down. So it's like the sun is setting with that evening star. And then that's obviously for sales, that's like the bearish candlestick pattern, the evening star. And then for like the bullish candlestick pattern would be the morning star. So price comes down and you have your small candle in between, or a doji, and then the large engulfing blue candle. Obviously morning star, so price is at the bottom, so sun's down and it's going to rise up. So yeah, that's the 4 candlestick patterns that we generally look for. And then in regards to where you would draw your Fibonacci tool, so you would draw your fib retracement tool on the engulfing candle. So say you had bullish engulfing candle, you would draw the Fibonacci from the top of the body, so not the wick, so the top of the body of the candle, and then you would draw it down to the bottom body of the candle, not the wick. So it's just the body, the top of the body to the bottom of the body of the candle, and then obviously it would give you your fib levels, and then you would enter on the closest fib. I hope that makes sense. I'm just gonna bring up trading view. There we go. Can you see trading view? You can't see trading.
Yeah, I can see it, Ryan.
Oh, you can. Can everyone else see it?
Yeah, I can see it now.
Oh, cool. So basically, so basically, I've just got an example here. So as you can see, the candlestick, so price has come down and it's created this pivot point in the market. So I've drawn obviously the one line to the body of the candle, and then the other line to the end of the wick, and then obviously that creates your zone. And then obviously the same for the top. So price has come up, it's created this pivot point in the market, and then we've drawn our zone from that. And then obviously if you was to look back in time, you can see that price is using that as a support. I'm just going to go back to it. So if we go back in time, you can see that price has come down and it's used this zone as a support, and then it's broken through that. So that's a good sign. Sorry, trading views not really moving a bit laggy. But yeah, you get the picture. So obviously, for some reason, it's not dragging back anymore, but you can obviously carry on going back in time, and you can obviously see when price touches them zones, and then obviously that gives you a better confirmation. And then obviously, as you can see here, so you see this blue line here at the top of the price, sort of running along the top of the price, and then you've got this orange one in the middle, and then you've got another blue one at the bottom. That is the double chain channels. And obviously, as you can see, where this is a blue straight line. So if you was to draw a zone there, you can see that that corresponds perfectly to where the price has made a pivot point. So it's made a resistance, and that blue line, that double chain channels, is right there. So if you was to draw a zone there and that line was inside your zone, that's a good confirmation, obviously, that your zone's in the right place. And you can see that obviously price, when it comes down, it wicks down, and where's it wick down to? That blue line. So you can really use them lines to help mark up your support and resistance. And then obviously the EMA 50 is this thick black line that runs through the middle of the price. So obviously, go back over here. And then you can see, so this is the 1 hour time frame. So you can see here, with this really long red candle, that's closed outside of our zone. So that's a 1 hour candlestick that's closed outside of the zone. And obviously going back to the confirmation checklist, the first confirmation is a 1 hour candle close above or below your zone. The second confirmation on the checklist is a retest at least back to the zone. So we know that prices broke out now. There's a 1 hour candlestick to close outside of our zone. So if we use to drop down to the 30-minute time frame, so you can see this is where price is broken out, this red candle, and you can see the price has come back up into that zone. Now, can you just put in the chat box, so price has come back up into the zone where it's had a little green candle, big green candle, and then we've got a red candle. Why would we not enter the trade there? Does anybody know? Just by looking at it. So the red candle is the same as the green candle. So why would we not get into the trade there?
Because it's not an engulfing candle, is it? Because it's the same size.
Yeah, exactly. Love that. So that's exactly right. So obviously, if you remember, we're looking for engulfing candles and we're looking for morning and evening stars. And this is neither. So this is no good. This price action here is no good for us. So we would not be entering a trade here. So as you can see, if you was to enter a trade here, you used to put your stop loss above that candle, your stop loss would have got hit, and it would have got hit. And then if you look, prices took off. So remember earlier I said to you I used to get into trades too early and then it'd take off. That's exactly why. So remember, you're always looking for certain confirmations. You've got to always make sure them confirmations are there. So we wouldn't get in on this red candle. And then prices come back up, and then we've got another red candle here. And I guess you could say that is sort of a bearish engulfing candle because it's larger than the green candle. But what we need to remember is if we was to say flick down to the 15-minute time frame, all right, so if we look, so earlier on I was saying you have to have the 15, the 30-minute, and the 1 hour all in bias. So that would be our first red candle that we was dismissing. So this would be that second red candle. So you can see that there is an engulfing candle there, and there is an engulfing on the 30 minutes. So now we check the 1 hour time frame. Now on them two red engulfing candles, you can see that on the 1 hour time frame would have been an engulfing candle, but for the last 30 minutes it rejected. So that's why you've got that wick there. So I wouldn't really count that on the 1 hour time frame as being like a definitive price action movement. I wouldn't say that a half of a body and then a half of a wick could be classed as an engulfing candle. I want to see the whole body of that candle really engulfed. So if we was to go back 30-minute time frame, so on the 30-minute time frame, we come to this red engulfing candle here. And then on the 15-minute time frame, it's an evening star, and on the 1 hour time frame, it's a red candle. I'm not going to keep flicking back between them. It's sort of lagging out my screen. I don't want it to freeze. So this would be the candle that we would use as our price action candlestick, because the 30 minutes is given an engulfing, the 15 minutes is given an evening star, and the 1 hour is given it was given two red. So out of that red candle with the rejection, and then followed by a red candle that pushes past where that rejection was. So all three time, the 1 hour, the 30 minutes, and the 15 minutes would all be in trending bias. And then what we would do is we would get our Fibonacci tool. We would draw it from the top of that candlestick to the bottom. We would get in on the closest fib level. So what does that mean, the closest fib level? Well, you can see. So this is our engulfing candle. So our closest fib level would be the 0.38, which is this first of the three black lines. And obviously you can see that when price made this wick, it would have engaged, took our trade. So we would have got in right here on this Fibonacci entry. Now our stop loss would be just above our engulfing candle. So we would bring that down. So you're probably looking an 8 pip stop loss, 24 take profit. So that would be a 1 to 3, a 1 to 3 risk reward ratio, and obviously as you can see it would clear. So obviously just to go back over the confirmations quickly, we had the 1 hour candle close below our zone, and then it retested back into the zone, and then we had the candlestick pattern, so the price action movement of all three, of the 1 hour, the 30 minutes, and the 15-minute time frame. They're all in a downtrending bias, and then obviously we entered on our closest fib level, and obviously we are twin trading, so you would obviously open 2 orders from the same place with the same stop loss, but they would not have the same take profit. There we go. And then also just to mention, so as you can see, we have this black line that runs through, and that's our EMA 50. Now we always want to make sure that our candlestick pattern that we look at is either closely above, we want to make sure that the EMA 50 is closely above or below that candlestick pattern. So for me, I like to always try and have that EMA 50 inside my stop loss, because a lot of times you will see that when price does make a pullback, what normally happens is it normally comes up to that EMA 50 and then it will touch that EMA 50 and use it as like a moving, in this case, resistance, and then price would then begin to move down again. So I always like to make sure I have that EMA 50, as you can see, within your stop loss, so that if price does come back up, you're sort of covered in that regards. Let me just delete this Fibonacci tool. We don't need that anymore. Right, and then what we would do is we would then, so this is 1 to 3 is clear, but we've still got our second trade running. So what we would do is we would then go to the 1 hour time frame, because we're going to be using shark money or the TDRGM indicator. Which is here, which has just come up on the screen. So this is it, the TDRGM indicator. And the reason why we say shark money is because, as you can see, there's a top blue line, and there's a bottom blue line. And that's inside them blue lines is what we like to call as the sea or the ocean or whatever you want to call it. So the sea, the ocean, the blue lines within it. And you can see that at certain points, the black plot line that runs in between them blue lines comes out. So you can see this black line comes out of the blue line, and then it will go back in to the blue line. So remember that inside the blue line is what we like to say is the sea or the ocean. The reason why we call it shark money, you can see the black line has come out. So the black line has come out of the sea, and then it goes back into the sea. And as it goes back into the sea, you can see like a little black triangle. So it's like a shark fin. So that's why we call it. That's why we call it shark money. Because when you see a shark fin, so when you see the black line come out of the sea, and then it goes back in and it creates that little, you know, like looks like a shark fin. That moment where it enters back into the sea is the moment where you want to be closing out your trade, because that would be the best possible opportunity to take as much profit out of the market as you can before price starts to reverse back up again. So as you can see in this example, if I get the vertical line, you can see that the black line has come out of the sea, and then right here, you can see it's created that, it's gone back into the sea. So the shark fin, it come out of the sea, and now it's going back into the sea. So if we was to move our down to here, so you can see that green line. So at the close of this green candle is where we would take our profits. People that go, yeah, I'd have took profits down at this red candle. They're chatting shit. They're lying, because the TGRGM, the line would be down. So if they're closing out while the line's down, there's nothing to say that that wouldn't just keep going down. So you have to wait until the line, you know, comes back up to be able to say, you know, price is going to start to maybe reverse for the next, I don't know, however many candles. So as you can see, that is the case. So you closed out a 1 to 3 and a 1 to 7. And then obviously at that moment when you took your profits out of the market, you can see that price started to go up. So if you were still in the trade, obviously you would have lost half of them profits that you would have made if you was looking at the TDRGM indicator. But it's also really important to remember that we only use the TDRGM indicator on the 1 hour time frame. So you can't use it on the 15 or the 30 minutes. It's just the 1 hour. And you want to wait for the candlestick, for the candle to close. So you want to wait for a 1 hour candle close and then take profits. Because as I said, you could have, say, 30 minutes of a green candle coming up, and then you think, oh, it's going to go back up, and you close out, and then the rest of the 30 minutes it completely goes back down the other way and price carries on. So yeah, you want to wait for the candle to close, and you want to use it on a 1 hour time frame. And yeah, that's pretty much all of it, to be fair. We've got pretty much covered it all. I mean, if anyone's got any questions or anything that they have, but other than that, that is pretty much it done.
Thank you, Brian. Smashed it as always.
Thanks. Yeah, I hope everyone got some value from this. I know not everyone's doing Forex at the minute, but if you can learn the skill, why not? And then when you eventually open up to do Forex, you'll be ahead of the game.
Brian, if you don't mind, in the morning, you could drop your charts in the chat so people can get started with it.
Yeah, probably be doing that as of next week, because I ain't currently trading anymore this week because I've got like a personal.
Yeah, definitely do. Whenever.
But yeah, I'll definitely start dropping the marked up charts in. And also, if anybody does have access to, because I'm not sure what everyone's packages are, but if you do have access to a Forex package, you could also watch Anthony Paris. He does a go live session in the mornings, and he marks up charts for you throughout the day. But actually, just saying that out loud, what I might do this week, instead of marking up my own charts, I might go watch his session and then put them charts into the group chat for this week. so everyone can use them. And then as of next week, I'll just put in my own charts. So yeah, cool. You're free to leave whenever you want.
Oh, thank you.
No worries.